This is Macro Horizons, episode 366. Hello, Spring, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of March 23rd. Friday marks the end of winter, and frankly, it couldn't have happened to a better season. Winter is going. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the war in Iran continued to dominate both the news cycle as well as market participants' attention. The run-up in energy prices continued on Monday and extended throughout the week. And while there were some moments of less constructive price action in oil and natural gas, they turned out to be comparatively short-lived. The debate is whether or not the amount of destruction being done to the infrastructure and the production capacity in the Middle East is going to meaningfully rebase the floor for energy prices higher for the foreseeable future, or if there's a conceivable path back to pre-war energy levels once the conflict is resolved. As the events in the Middle East continue to unfold, the assumption is that the more damage that's done, the longer it will take for the energy market to reverse to prior levels, if that's ultimately possible at all. The FOMC meeting was somewhat surprising insofar as the post-Powell response in the Treasury market was a significant bear flattener. The two-year sector sold off sharply, with yields coming within striking distance of 4%. That represents a very significant cheapening of the front end of the curve, and it is notable that two-year yields are now above effective Fed funds and even above the upper bound of the Fed's range, which is 375. In an environment in which there was a downward bias on policy rates, as was communicated in the Fed's SEP via the beloved dot plot, one would expect that effective Fed funds should serve as a cap or a ceiling for nominal two-year rates. The fact that two-year yields are now trading above 375 indicates a degree of symmetry around current policy rates that we'll argue was not necessarily reinforced by Powell. Nonetheless, the two-year sector has cheapened, at least in part, in sympathy with the sell-off in the gilt market, as well as EGBs, with both the Bank of England and the ECB communicating a decidedly hawkish shift as a result of the war in Iran. The fundamentals were also consistent with a bit of cheapening in the Treasury market. We saw PPI come in above expectations for February, both the headline as well as the core measure. Core printed at 0.5% on a month-over-month basis, and the upward pressure on producer prices occurred before the latest escalation in the Middle East, which implies that producer prices will continue to see an upside bias in the near to medium term. Initial jobless claims, which represented NFP survey week, dropped to just 205, reinforcing the notion that there remains a solid underpinning for the labor market with the unemployment rate at 4.4%, even despite the fact that we saw a pretty significant drop in headline payrolls for the month of February.
There was no shortage of trading impulses for treasuries this week. Obviously, the war in Iran is ongoing, and despite what President Trump has said about the excursion in the Persian Gulf ending soon, there seems to be no end in sight for the attacks both on Iran itself and the retaliation on other Gulf countries that seems to be increasingly focused on energy infrastructure, which added to the overall risk-off tone of the market, keeping equities under pressure and inflationary concerns intact. But really, the main event of the past several trading sessions was the FOMC, where Fed funds was left unchanged and the dot plot continued to show another rate cut this year, with another one to follow in 2027. but the interpretation of Powell's press conference was decidedly more hawkish and added a meaningful amount of bear flattening pressure on the curve that ultimately saw 2-year yields cross 3.9%. Yes, that was in the wake of more hawkish monetary policy decisions in the UK and Europe, but nonetheless there is a growing sense that maybe there will be a more material rethink on the path forward for Fed funds, given the more lasting influence of the repricing we've seen in the energy complex.
And it is a fair argument that the more infrastructure and production facilities are damaged, the longer it will take to get energy production from the region back online. And to some extent, that's the dynamic that's playing out in the energy sector at the moment and has been fueling, pun intended, higher oil and natural gas prices. Even if there were to be some type of resolution or off-ramp for either side in the near future, the dislocations created by the last 7 weeks have created sufficient uncertainty that it will take a meaningful amount of time before we're on the other side of this from the perspective of what it means for the energy sector. That being said, we're still in the point of escalation rather than de-escalation, and as a result, financial market participants, both in fixed income and equities, remain focused on the Persian Gulf and all of the related headlines and developments. There will come a point at which the market moves beyond trading the war, although clearly that wasn't this week. We had approached the Fed meeting operating on the assumption that in the event that the Fed chose to retain the 25 basis point rate cut for 2026 in the dot plot, that would help the front end of the curve. And in fact, the 2-year sector just continued to sell off with a 4-handle 2-year yield coming into range. Now, we're wary against drawing the parallels between what's going on in the UK and Europe with the comparable implications for the Fed. The ECB and the Bank of England only have a single mandate, and that mandate is price stability and fighting inflation. Layer on top of that the fact that there's still a war in Ukraine and the proximity of Europe and the UK from the perspective of energy supply to the Middle East clearly has different inflationary implications for the continent as well as the UK.
And while yes, the cross-asset price action has been of the risk asset variety with credit spreads widening and equities under a bit of pressure, broadly speaking, the S&P is not really that far off all-time highs, and the repricing in stocks and uptick in volatility certainly hasn't reached the point of a financial conditions issue which would make the Fed any more cautious about holding rates for the time being. However, as we think about the potential for a more significant tone change in the Middle East, we're left to consider the political implications of what could be more downside in stocks and obviously the wealth effect and simply negative headlines that would follow a longer period with oil prices at these levels, not to mention the influence on gas prices and generally what that has tended to correlate to in terms of consumer confidence. The current administration has placed a great deal of weight on how the stock market is doing as an indication of overall economic performance, and so while we're not at the Trump put price yet, it's not unreasonable to assume that the longer oil stays elevated, gas prices stay high, and equities continue to struggle, the less political will there's going to be in Washington to continue the offensive against Tehran. Now, where that inflection point ultimately lies is anyone's guess, but as Trump and Hegseth have continued to stick to the several weeks timeline, and we're approaching the end of the 3rd week of the war, the debate is becoming how much longer the White House is going to be willing to escalate from here, not to mention what higher prices at the pump might ultimately mean for the midterms, although that's still over 6 months away.
You make a good point, and the looming midterm elections are certainly going to enter the political calculus at one point, especially if what started out as a weeks-long war turns into several months. Now, it goes without saying that the focus at the moment remains on the Strait of Hormuz and the potential for safe passage of oil and natural gas out of the Persian Gulf. As it currently stands, the strait is shut to the U.S. and its allies for all intents and purposes. We've heard a few announcements from the administration regarding potential near-term workarounds, including lifting sanctions on Iranian oil that is already in international waters. That being said, the flow-through to the energy sector has been relatively muted thus far.
And the war has reached the point where now it's not just the price of oil that's going to be impacting the global economy, but we've heard from Qatar that the damage done to their LNG infrastructure is going to take somewhere between 3 and 5 years to fully come back online. That's just one example, but it's not unreasonable to assume that with each passing day of Iranian missile and drone strikes on energy infrastructure around the Gulf, that the damage is going to continue to compound in a way that's not going to be easily resolved in a matter of just a few months. This calls to mind the quote-unquote supply chain issues that plagued the global economy in the wake of COVID and similarly when Russia invaded Ukraine, and the fact that such a critical portion of the world's energy infrastructure has now been set back in terms of its potential output is going to mean that even once this conflict is behind us, that we're not necessarily going to see a sharp reversal in oil and gas prices back to where they were a few months ago. Returning to the earlier conversation about the BOE and ECB versus the Fed, this also holds different implications for the US and North America than it does Europe, given the distribution of energy resources, but it's another facet of the economic implications of the war in the Middle East to consider in evaluating the likelihood that the market quickly moves beyond the current disruptions.
Shifting gears slightly, there was another notable takeaway from Powell's press conference, and that was the fact that he has now publicly said that he has no intention of leaving the board until the DOJ probe has been resolved. Now, that doesn't mean that the probe couldn't be dropped in the very near term to clear the path for Warsh's confirmation, but given the rhetoric from the administration, that doesn't seem likely in the very near term. Powell also said that in the event that Warsh's confirmation hearings are delayed because of the DOJ probe or any reason, he will stay on as the acting head of the FOMC. This wouldn't be an unprecedented move and was generally assumed to be the case before Powell acknowledged it. On the other hand, we'll argue that part of the hawkish interpretation of Powell's press conference came from the fact that he could remain a key influential member on the FOMC for several more meetings as opposed to April being his final meeting as chair. It goes without saying that Powell has done a great job in retaining central banking independence, and as such, and in the context of the war in Iran, higher energy prices reintroduce the risk of a flow-through to core inflation and have clearly left the chair in a more balanced, if not outright hawkish policy stance at the moment, at least until there's more meaningful clarity coming out of the Middle East.
And what that means is, say Warsh is confirmed on time, he takes over as chair, and Powell returns to a governorship on the board of the FOMC, looking out over the balance of 2026, depending on how long the DOJ's probe lasts. What this means is that there'll be another governor, Governor Powell, who will be submitting dots and voting on the committee's policy actions. And while Powell has done his best to stay apolitical, it's not unreasonable to assume that his experience as Fed chair might shade his opinions more hawkishly than would otherwise be the case, particularly if oil stays higher for longer. So even if Chair Warsh wants to cut, he might not have the votes.
So what you're suggesting is we might be facing a case of a dissenting chair?
It's terminal, right around 3%.
Wait, I get it. In the week ahead, the focus in the U.S. rates market is going to remain on developments in the Middle East and the degree to which the war is damaging oil and gas production infrastructure. As it currently stands, there's no obvious resolution on the horizon, and as a result, investors will be closely watching developments in the energy market to see whether there's another leg higher in oil and gas prices in the near term. And we suspect that if that were to come to fruition, we would see the sharpest price action in Treasury space occur in the 2-year sector, with four-handle twos certainly a possibility. Moving further out the curve, while we have seen 10 and 30-year yields increase in outright terms, the moves have been comparatively muted to what's occurred in the very front end of the curve. We take some solace in this, if for no other reason than it's consistent with investors acknowledging some of the near-term inflationary risks, but also translating through to potential growth concerns. After all, higher energy prices could translate into consumers needing to make difficult choices as a greater share of disposable income is used up at the pumps. The week ahead also includes 3 Treasury auctions of relevance. We have $69 billion 2 years on Tuesday, followed by $70 billion 5 years on Wednesday, and capped with $44 billion 7 years on Thursday. Overall, it's not a week in which we're expecting that the economic data will be particularly pivotal for the direction of rates, if for no other reason than the ongoing conflict in the Middle East. Moreover, there are really no top-tier releases of any relevance. Thursday morning's initial jobless claims will be incrementally relevant, but as the data is not for non-farm payroll survey week, and we're coming off at still relatively subdued levels, it's unlikely that anything to come out of the claims update will materially change investors' understanding of the fact that the labor market appears, at the moment, to have reached a point of stabilization. In terms of the magnitude of the recent price action, we came into the week just past viewing the 2-year sector as notably cheap, and it's only gotten cheaper. That has left us cautious of stepping in front of this move, especially when the move is being driven by what we'll characterize as the external factors of armed conflict in the Middle East and the implications for the energy sector. At one point, we'll be advocates of buying the dip, but we suspect that there's still another leg higher in energy prices, as well as another leg higher in front-end yields before markets calm and reach a new dynamic equilibrium. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as month-end approaches, it strikes us that these few weeks are probably not what they meant by March Madness. But what do we know? We don't follow professional football. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.